So for part 3 on our overview of current liabilities, we're going to discuss accounts payable a little bit further and how it relates to inventory systems. Now, when it comes to inventory purchases, how you record your journal entries depends on the inventory system that you're using. There are two basic inventory systems, the periodic inventory system and the perpetual inventory system. Now, the periodic inventory system is basically the historic way that we recorded inventory. It's usually because we didn't have sophisticated computer systems or maybe inventory records that we would have the staff to manually update on a regular basis. So we used the periodic inventory system to track inventory, come up with cost values for both our inventory and our cost of goods sold. So inventory is usually counted at the end of a financial reporting period, whether it's a month, a quarter, or a year end. So we've accumulated all these costs related to all our purchases for that financial reporting period. And then at the end, we count this inventory and we do accounting adjustments to close out all that value we've collected for purchases, put some of it in the ending inventory, and move the rest of it into our cost of goods sold. So it's all based on that periodic inventory count. Now in the perpetual inventory system, that means we've got more updated accounting records and systems that allow us to track every transaction that happens during a period, purchases in, sales out, any adjustments related to pricing that goes on, that's all tracked so that in any given day, at any given point of day, we could run a report on a particular inventory item and it will tell us how much inventory we should have on hand. Now, granted, there's going to be human error in entering things. You select the wrong item that you received. You might have miscount that receipt that you've got. So we have what's called cycle counts, which are tests of the inventory. We'll select a few items and go out and actually count it and verify that the perpetual system is accurate. And we'll make adjustments to our inventory based on what those cycle count results may come up to. We'll also try to figure out why we had those mistakes and try to fix the process problem related to that. And a lot of times in these cycle counts, we'll look at the big valued items to make sure they're accurate. We'll also look more regularly at maybe the fast moving items that are more popular items to make sure that one's accurate too, because we don't want to accidentally be out of stock because we've got some inventory transaction problems there. But those are for your audit lectures in the future. So that's the basic difference between a periodic inventory system and a perpetual inventory system. But let's get to the point of how it affects accounts payable. So let's first review the periodic inventory system. And again, this is a current liability focused video, so we're only going to go as far as the accounts payable transactions. So if you want to see lectures further on how it affects cost of goods sold and inventory, you can look at those videos on inventory, cost of goods sold, perpetual versus periodic and whatnot. But we're going to focus on accounts payable right now. So our company is going to purchase $50,000 of inventory on account and with terms of 210 net 30. Now in the prior video I talked a little bit about what terms meant. So we're going to take advantage of that 2% in 10 days. So we're going to try to pay that off within 10 days and take advantage of that. We also have freight costs of $1,000, which means if we have the freight costs, it was most likely an FOB shipping, which that in the previous video we discussed means we're paying the shipping costs, and we'll have an account called freight in under the periodic inventory system. So let's record that transaction. We've got our purchases, which will be accumulating throughout the period. And then again, at the end of the reporting period, some of these purchases will go to inventory as an asset, and some will go to cost of goods sold. But right now, we're recording that purchases account, $50,000. The offset is our accounts payable. We have this liability to a vendor for $50,000. We're going to record that freight in cost, which is tracked just like the purchases. At the end of the period, we're going to put some of that to inventory assets, some of it to cost of goods sold, and that's $1,000, and then we're going to have paid cash for that, we're assuming. So will credit cash for that freight cost. Next comes up, we find through inspection that 5,000 of this inventory is not acceptable, and we're going to return that to the vendor. When we do that, we're going to actually lower our accounts payable by that $5,000 worth of inventory, and we're going to record it, the credit, in an account called Purchase Returns and Allowances, so we can keep track of these returns and allowances that we're having over the period of time. Again, at the end of the period, that purchase and returns and allowance is going to be cleared out to either our inventory asset or be part of our cost of goods sold expense, depending on how we do our reporting. Then finally, our company decides to pay that vendor within the 10 days to take advantage of that 2% discount. So the accounts payable was the $50,000 originally, less the $5,000 in returns, so $45,000 is in accounts payable, but that's not what we're going to pay because of the 2% discount. So the discount's going to equal that $45,000 times 2%, or $900. So we're going to subtract that $900 from what we pay our vendor to take advantage of that 2% discount. So our entry is going to be accounts payable. We'll get rid of the whole $45,000 liability. We're only going to pay cash of $44,100, which is the $45,000 minus the $900. And then we're going to record that purchase discount as $900. All right, now let's see how this changes under the perpetual inventory system. So we have the same exact transaction, $50,000 of inventory, $1,000 in freight costs, same terms, and same shipping terms. So the difference you'll see here between this entry and the perpetual versus the periodic is every transaction is going to be going to inventory. So there's no purchases account, there's no freight in account, it's all going to inventory. The accounts payable is the same though, $50,000 credit for that amount that we owe our vendor. When we had the return product, same exact adjustment to accounts payable, we reduced it by $5,000, and again, instead of returns and allowances, we're using inventory as our account. And then finally, when we have that payment and our 2% discount, the only difference we're seeing here is, again, the inventory asset is used as opposed to the purchase discount value. So at the end of the day, our final note is the accounts payable account effect was the same regardless of whether you used the periodic or the perpetual inventory system, but I wanted you to see the difference in the transactions between those two systems. So I hope that helps you understand accounts payable as it relates to inventory systems. Remember to like this video if you liked it, comment on this video if you'd like to see something else discussed, and subscribe. So have a great day and see you in the next video.